Thank you all for joining us this morning for our quarterly investment update. I'm joined this morning, for those of you who don't know me, I'm Kristi Grys. I'm the Chief Investment Officer here at Merriman, and this is our general quarterly investment update on what's happening. I'm joined this morning by Paresh Kamdar. He's one of our longtime advisors here at Merriman. He joined us in 2007 after many years at Schwab and in other versions of this, sort of came to us as part of the drawn by the fiduciary environment that we offer, always putting clients first and doing what's right for them. And he, I can say this, he just really loves making an impact on clients' financial lives. And I get the privilege of seeing him do that every day here for those of you and those of you who are privileged to have him as an advisor. He's a wonderful member and resource on our team. This is a picture of him and his wife, Sybil. They enjoy spending time in the mountains with family and friends. So if you ever need any recommendations or any lessons on anything in the outdoors, Paresh is absolutely your guy for that. So bringing peace of mind and then finding it also for himself. And I think that's going to be a theme as we get started here and talking about where we are in terms of markets and eventually getting to that all favorite subject, which seems to be the thing that's making clients most nervous, which is the upcoming election. So I'll be talking briefly about what's going on in markets, and then at the very end talk about, some of the myths surrounding elections and markets, and hopefully try to bring you some peace of mind on that subject. We do have an active Q&A opportunity for you during this time. So there's a Q&A button on your screen. If you open that and you type in your question, Paresh will be monitoring that during the chat, and I will try to pause and answer those questions throughout. So whenever you have any questions, feel free to type those in. Also, thankfully, it's been a relatively positive time in markets this past quarter. So we might be a little shorter than some of you who've joined each quarter. So if you have other questions on things that maybe I haven't covered, hopefully we'll have a little bit of time at the end of the session for you to ask those questions. And again, just type them into the Q&A as you think about them, and Paresh will ask them at the appropriate times. So with that, we'll jump into a little bit of commentary from myself on what's been going on in markets and the economy since we last spoke. So while everyone isn't declaring that we've achieved a soft landing, for those of you who have been going through this for about the past few years, we've been dealing with the pandemic, and then what I would now consider kind of declared a post-pandemic inflationary period, a big disruption all related to the pandemic, the shutdowns, the response to that. And while the future is never certain, at this point, I think that we have to declare a soft landing because of the success of the monetary policy. That doesn't mean inflation isn't going to come back again. That doesn't mean there's not going to be a recession. There's going to be a recession sometime in the future. I don't know where that is. But I think for two very important reasons, we have to draw a line in the sand and say there's been success, and whatever happens going forward is a result of all the other things that are always happening in the world and not really associated so much with this kind of post-pandemic inflationary recovery period. So why do I kind of am declaring a soft landing, even though there's never any black and white in the world? First is, in this past quarter, the Federal Reserve was able to have an interest rate cut for the first time since the pandemic. So this is kind of a historical chart showing the Fed funds rate. It goes up, it goes down, it goes all around. So we were at a very low interest rate environment coming into the pandemic. And it was dropped to try and help our citizens, global citizens, withstand the difficulties of the pandemic. So we had very low interest rates. And what we found was that post-pandemic, due to supply disruptions, due to all of the uncertainty of being in the office, going back to the office, buying lots of exercise equipment for our home gym because we could no longer go to the gym, buying all the new desks. I remember my kids had to do homeschooling and there weren't enough desks in the house. So everybody was buying things for their house, huge demand for things that we didn't need. And so all of our lives were upended globally, and people had new demands and other areas. And that created a huge sort of wave that has gone through the system. We had that. There was inflation. So the Fed raised rates in an attempt to reduce that inflation. And they have actually gotten inflation under control. It is resumed. I don't have a chart in here, but it is kind of leveled out in the 2.5%, 3% range. Exactly where it will land, who knows? But we've gone back from the 7%, 8% kind of headline numbers that folks were saying, and to the point where the Fed was able in September to lower the Fed fund rate. That's this point you see right here. Hopefully you can all see my red pointer. Excellent.
Yes.
So, and the market is expecting the Fed to be able to cut rates further down to that kind of 3% level. No one knows exactly where it'll head out. But the fact that they have been able to get to the point where inflation is under control and they are lowering interest rates is a huge success. Second of all, so I consider the first mark of the soft landing the point where we have been able to lower interest rates and declare that that inflationary period is over. Second, the reason it's a soft landing and not just a landing is because they've been able to do that without causing the economy to contract. So this second graph is sort of a measure of the change in GDP. So GDP is sort of the growth, the domestic product of the US. And when the gross domestic product is growing year over year, production, income, the economy is growing, you see these numbers in the 2, 4, 1% range. All of that means the economy is growing. It's producing more, it's employing people, right? And you can see that when there are periods of negative GDP, that's when we are in a recession, right? There is a higher unemployment, businesses are not expanding, they're not investing. And that happens. It's happened throughout time. You see this huge disruption here in GDP. This is the pandemic. And again, I like to think of it as that sort of like rat going through a snake. When you see snakes and they eat a rat, it's sort of this big disruption that went through the economy. And we see that. And now we've come out here and we're in the kind of 3% range of GDP, GDI growth that marks a healthy economy. And we've been able to do that without a recession. So you're talking about a period in which we've been able to get inflation under control, and we've been able to do that without causing an increase in unemployment, without a contraction, a serious contraction in the economy. And where GDP drips down to zero, GDP growth, negative, right? None of these recessionary period indicators have occurred. We've been able to tamp inflation down and get to a point while the economy is still growing. And, you know, this is my personal belief, but I think with all the election headlines and all the concerns in the world, it's easy to forget how important this is and how much of an accomplishment it is, and also how scary it was a couple years ago when no one thought we could do this. But a major accomplishment of being able to get through this very difficult period for the world and also do so without massive increases in unemployment or a recession. And we're all feeling pretty good, right? Like pretty good about this. And sort of like good news doesn't make headlines, right? So all this good news feels to me like it's getting lost in, oh, everything's okay. But this has been a great testament to the pessimists and the bears. They can be wrong. The economy can get through this period while delivering for investors.
Kristi, it brings to mind Warren Buffett's one of his famous sayings that economists have predicted 9 of the last 2 recessions. Uh, and we do have a question.
Yes.
He's asking that with the expectation of additional rate cuts, are there action items we can take with our cash or our mortgage? And I think it all depends on what your current rate is, on whether you should take action on your mortgage. And it's unlikely that rates have dropped enough for many people to consider a refinance. But we'll just have to wait and see, because even though we currently have expectations for additional rate cuts, the reality is that those rate cuts are going to depend on the numbers that we see in the economy over the next few months. And with cash, I would say that we always want to keep this 3 to 6 months worth of cash, because cash and the risk-free rate is always going to come fairly close to inflation. So I don't see any changes in how we should treat our cash with the current rate environment and expectation for lower rates. Do you?
No, I don't. You should always keep the amount of cash, like Paresh said, that you need to have access to the liquidity, access to that cash for spending needs, for emergencies, to buy that new car. But beyond that, we don't advocate keeping cash, even in what appeared to be a very favorable cash rate environment, right? That 5% that kind of was probably, no, we don't know, probably the peak rate one's going to get on cash is because you don't lock it in, right? As soon as the rate cuts happen, all the high yield savings providers were dropping that rate immediately. So if you have excess cash on hand, you should have been investing it beforehand. But if you're not, absolutely want to get it back invested in the market. But we would advocate for keeping that cash invested through the cycles, because one doesn't know what's going to happen next. And again, as we saw from the pessimists, right here, if I can get my slides to go, this is the year-to-date return of global equity markets, right? This is a period in which people thought that there was going to be a recession. Certainly the markets were going to go down. And you see a few bumpy rides in between, right? You see these periods where there was pretty big drawdowns. But at the end of the day, all those predictions that there was going to be a recession and maybe reasons you kept cash on the sidelines, you missed out. You missed out on positive bond returns. You missed out on positive equity returns, right? So one never knows. And the best advice is to keep that cash or whatever money you have invested, because those predictions, you just don't know, right? Like on average, the market is going to go up every day. We don't know when days it's going to go up, when days it's going to go down, but on average, it's going to go up. And we want to be invested in those kind of days, because those are when we get those kind of returns. And oftentimes the scariest times are the times that deliver the biggest returns. So yes, if you already had cash on the sidelines, now is definitely the time to get it invested And we also offer for those folks who, find peace of mind in having more cash on hand during really scary times. Our TrendWise strategy can be an approach for going to cash in market stressful times. So if that's something that you really feel like is a fit for you, please absolutely reach out to our advisors, your advisor here at Merriman or us, and we can see if that strategy might make sense for you as a way to get you in and out of the market with a mechanical system as opposed to any prediction about where markets are going to go. Because, as you can see from this chart, like despite uncertainty, it has been a really good year and continues to be a really good year for market investors, which is just great, right? Like this should be the time when you can feel really good about your portfolio. That begs, so we'll get to, is it too good to be true? But I want to go through a few things that will set the stage for that and dive a little bit deeper. First is that US tech stocks, which have been the theme for a decade, but certainly a theme for the last 2 years, have continued to, within the global equity markets, been the best performers. It's just shifted exactly what we consider that Mag 7, but in general, those Magnificent 7 large US tech stocks have continued to outperform the global market, both in the past couple years, but also year to date. However, I will point out that that gap has been closing, right? So if you look at the S&P X, the Mag 7, so this is the 500 largest US stocks, minus the Mag 7, you can see that the gap between that and the Magnificent 7 returns was very large in 2023, right? So 8% versus 76%. Here, the rest of them have gone up from 8 to 11, and the Magnificent 7 returns still incredibly good, but have fallen down. And that's what people have been predicting would happen, which is that gap is closing. It's not closed yet all the way, but it is definitely closing. And I'll talk in a little bit about that this is consistent with kind of the early stages of a typical bull market. Every bull market, every economic situation looks different. We always plan for the last one we remember, not for the one we're currently in. But this prediction is the Magnificent 7 and the rest of the markets are going to start converging. We're starting to see that. It's unclear, the Magnificent 7, like people have been really worried. I hear a lot of worry, well, is this another tech bubble? And the answer is, you never know, right? Certainly the price to earnings of these stocks is higher than it's been. But the reality is, the reason it hasn't been another tech bubble yet is because the Magnificent 7 has been continuing to increase their profit margins and increase their earnings. So certainly their price has been going up. And one always wants to be very conscious about buying things at high prices. But so far, they've been able to deliver profit margin growth. Again, here, this is the bottom. You can see all their profit margins have been going up, starting to narrow out, but they've been able to keep up high profit margins, and they've had very strong earnings growth, right? So here again, you see really high earnings growth. So while their price has gone up, their earnings growth and their profit margins have also been climbing. So there isn't this high price, not making any money, which is consistent with a company you don't necessarily want to invest in. Where this goes from here, we will see. These are predictions about where earnings growth is going to be. still seeing very positive earnings growth from the Mag 7 and the tech stocks. But again, starting to see the rest of the market catch up to those tech stocks. So that'll be something super interesting to watch. The mutual funds and ETFs that we use in our portfolio are always evaluating on a daily basis where the price is, where the profit margins are, where the company is going. And so we're always in all of our strategies looking at, are we paying too much for a company based on its profitability, based on its current price? And we will be adjusting within the funds. You don't necessarily see this in your portfolio, but within the funds that are in your portfolio, they are adjusting to make sure that we're trying not to buy things that are at too high a price if they're not delivering results. And so have exposure to many of the Mag 7 stocks, but again, they're being evaluated and that exposure is changing over time as we look at this. But it's not, these are high price stocks, but they're also delivering results. And so we want to be careful that we don't assume that just because it's a high price, you don't want to be evaluating. But we also want to be very thoughtful about buying or investing in stocks when they're at a high price. And that's something that's being evaluated within the funds that we use on a daily basis and adjusted as trends and data change. Paresh, do we have any questions before I move on?
Not yet. But if anybody has a question, please enter it in the Q&A.
Great. So many folks, well, it's a definition, have determined that this kind of 2022 down here was the bottom, and we've been in this bull market since then, right? Somewhere down here is declared the start of the bull market. And again, typically in a bull market, the initial stages of that bull market are not as much driven by US large companies or kind of the stable consumer goods companies. Their bull markets are typically, again, this is on average, nothing is ever average, nothing ever looks the same, or it would be easy to invest. But typically we see signs that certain asset classes are getting stronger. And one of the things that we think of bull market starting with is that small cap stocks, small company stocks tend to recover very quickly. So if you think about 2020, that's the COVID crash. After that, small value stocks, small stocks rallied extremely quickly from the bottom. That was also true coming out of the 2009 recession. So that's the blue line and the purple line. You can see that small cap stocks, the first year out of the bull market, they did very, very well. They tended to lead all of the other asset classes. This recovery has been very different. And again, the tech stocks have continued to dominate. Instead, small cap value stocks, small cap stocks have yet to experience much gain, right? They've gone up. It hasn't been that they've gone down, but they certainly haven't rallied like they have in many, many other bull markets. Exactly why that is, who knows? But it tends to support that we are still in the early stages of this bull market, and there's still opportunities for a lot of the rest of the market to continue to deliver really good returns as we get more and more economic certainty, as consumers become more confident in the recovery. And we've seen a lot of volatility and continue to see in this kind of small cap stock space. As many of you know who've been clients for a long time, we have a tilt or kind of a preference for these small stocks, and we have yet to see that recovery, which means those areas of your portfolio are doing well. They're delivering positive returns, but they haven't necessarily been as good of performers as one might have expected in a strong bull market. And that's also why we want to be careful about making predictions. We want to be careful about making any type of over allocation based on the fact that we're now in a bull market, that small value stocks will do well. They will eventually, but we don't know when that recovery. And it's been very, very slow, as you can see from this dark line, compared to many other bull market recoveries.
So, Kristi, there is a question
Yeah.
about this.
Yeah.
It's been painful at times watching the S&P 500 continue to outperform all other asset classes.
Yep.
And it has happened for over a decade now.
Yep.
So how long is long enough before we switch to chasing the US large cap allocation?
Yeah, it's a great question, and one that we're always asking ourselves internally is when is enough. And actually, that was the motivation for introducing our factor trend overlay a few years ago, was as a way to understand or appreciate that there are macroeconomic momentum cycles in markets that have to do with global politics, that have to do with tax policy, and nothing is ever certain. So we still believe that the tilts to small value, to international, are important part of our portfolio, but also recognize that there are these long-term sort of cycles of momentum in markets. And maybe there's a way that we can sort of try to have our cake and eat it too, I guess I would say, which is have a little bit of overweight to the US, to large cap stocks in periods where there is strong momentum in those areas. And so, for instance, right now we have been, for the past year, our factor trend overlay has been fully allocated to US large stocks. And that has been actually a very favorable development for our portfolios, compared to if you go back and look at the portfolios that don't have factor trend overlay. It has been a very positive contributor to return. So that's kind of how we have been addressing that need. And certainly if that were to continue for another decade, we would continue to have our factor trend overlay allocated to those stocks, with the recognition that there's kind of a large macroeconomic momentum cycle. The nice thing about our factor trend overlay is at some point that cycle will end. I don't know when it will be. I don't know, but momentum is one indicator that we can use that has been shown to be statistically significant, lots of academic research, and can be a positive value to address that, while also recognizing that we still think eventually there'll be a recovery in small value types of market in international. I'm going to show a little later some of the things that have been happening in China and how fast sometimes the momentum can change and we can have different results.
Yeah, great. Factor trend overlay, again, is just the, as one of our colleagues described it, a weather vane that's catching the direction of the current momentum. And so I think it's helped quite a bit recently.
Yeah. And has been in US large stocks. So it's done well there. I think it's also important to talk about another asset class and kind of how it is reacting to this early stages of the bull market. And that's the Lendex fund, the Stone Ridge Alternative Lending Fund. If we take this same type of start of the bull market in basically 2 years ago, in October of 2022, and we look at days, you can see that the bull market started and Lendex returns were negative for that first roughly 1 year. And that is very consistent with the start of a bull market, and even if we don't have a recession, many times you will see that consumers are challenged in that period. So maybe unemployment isn't challenged, but consumer debt increases. And you can see that this is a chart of the percent of balance delinquencies on credit cards, auto loans, more than 30 days. So these are people who have taken out loans but are having difficulty paying them off due to job loss, due to savings reductions, right? US consumers saw a huge increase in savings during the pandemic because of the stimulus money from the government, because they weren't able to go out and travel, go out to eat, make purchases, see family, weddings, etc. And so there was a huge increase in the savings rate. And since then, it's been coming down. And you see that there's been more delinquencies in auto loans, there's been more delinquencies in credit cards. These aren't exactly the same kind of loans we are making in Lendex, but they give you a kind of picture into the fact that consumer loans, even though there hasn't been a recession, consumers are experiencing some level of financial stress that is resulting them having more delinquent balances on their loans. And that is what contributes to this downward trend in Lendex that we saw sort of last year. There's been a strong recovery this year. I would anticipate that unless there's a recession, that's likely to continue. You can kind of see, if you kind of think about what happened in past times of economic stress, that delinquencies rise and then they tend to fall again. We're seeing signs of that in these kind of, unfortunately, the data comes out late, and so, but we're looks like we're starting to see kind of a peak in delinquencies, and then if it's like past economic cycles, we would expect to see this come down. And again, that's very typical of kind of the early stages of a bull market, where you see consumers having difficulty, then consumer confidence rises, inflation goes down, and the consumer tends to be stronger, their loan performance tends to go. So there are many things that could, other things that could happen in the world that could change that trajectory at any point, but that is kind of the typical trajectory and what we have seen in past with consumer lending, which is the market starts to rally, consumers are still having difficulty, and so consumer loan products, Lendex, have negative returns, and then after the start of the bull market, there tends to be a strong recovery, which is again what we're starting to see this year. I think Lendex is up about 1.5% to 2% year to date, and we're seeing delinquencies on those loans fall, higher quality loans, new loans being issued, and so right now we would expect this behavior to continue as long as the economy continues to be strong. Any questions, Paresh, before I move on? Great.
No new questions yet.
Okay, that's great. We have plenty more to cover
about the election, but I think you have a few slides on that coming up.
I have 2 more things to do before we get into that, just to kind of give you a sense of kind of things that can make people nervous and how markets can change. The first question we've been getting a lot, which is this, it's been really good. Like, is this too good to be true? Like, should I be worried? I'm worried some people are worried at the bottom because it's going down. Some people are worried that, oh man, we're in a bull market. Actually, things have been really, really good. Should I be worried that they're too good? And the answer is no. There is no reason to believe that markets making new highs, a strong bull market can't continue to persist for years, right? The disruptions of the pandemic, the disruptions of 2022, they're actually relatively recent, and also bull markets can last, a very long time. So this graph just gives you some idea of that. The bluish kind of teal bars are the returns 1, 3, and 5 years later after the market has made a new high. So this is on the up. 1 year later, what's the return of the average return of the market? 3 years later, 5 years later. So this is all months. And this yellowish color is after a record high. And you can see that 3 to 5 years later, it doesn't matter whether it's any month or a month after record high. The expectations are the same for the forward-looking returns. That doesn't mean it's going to be 10.3%. We don't know what it's going to be. It could be, 2%. It could be 20%, right? But there's no information contained that helps us predict whether the market is going to go up or down just because it made a new high. That's not a time in which you can predict whether new highs are good or bad for future returns. Interestingly, 1 year later, it's actually positive for making better returns. And again, this is this momentum effect that I talk about, which is there's not much predictive power in the market. But actually, the one thing is that over roughly the 1 year time frame, it is statistically significant, not a guarantee in any means, but is slightly more likely that the market will go up, will continue to go up when it's going up than go down. There's always momentum shifts, but it is slightly more favorable if the market is going up, that it will continue to go up. And you see that actually 1 year later, the returns are more positive after months with a record high. And that's that momentum. So again, what's doing well currently tends to continue to do well on average, or it's slightly more likely than average. So actually, you could argue that now is a really good time to be invested and not a time to be worried. But again, never any guarantees. No one knows what's going to happen.
And Kristi, this chart is based on past data. It's not a predictive chart, correct?
No.
What we've measured.
And this is average, right? This is the average. This is like, okay, the average return of the S&P, right, like is 7-8%. I don't have the exact number off the top of my head. But the fact of the matter is there's almost 0 years in which the S&P actually returns 7 or 8%. Sometimes it returns minus 20%. Sometimes it returns positive 30. Sometimes it returns 0. Sometimes it returns 10, right? This is the average. This just tells you that there's no predictive power or information contained in this that can tell us whether it's going to go up or down. And it does not mean it's going to do 10.5%. It just means that on average, that's what it has done. And it's done the same regardless of what's happened that previous month. New highs are not bad. They're not positive predicting. They're not negative predicting. There's no information that we can use to make predictions. If we think there's information on what's happened in the past that we can use, we'll absolutely use it. But there's no information contained here. So you shouldn't be worried. You shouldn't be overly optimistic or overly pessimistic. The best thing you can do is just continue to stay invested day after day. And, if you roll the dice enough times, you're going to get the average over a long period of time. And you're going to be able to experience the positives of that on your financial well-being. Along the lines of, how things can change quickly, China. Let's talk a little bit about what's been happening in China recently. And so in this period where the global stock market has gone up over the past year, you can see that up until about September of this year, China has not experienced any growth. And I know there's been a lot of worry. Actually, one of the requests we get from folks, one of the more common customizations, which we don't get a lot of requests for customization, but we do, is to not have China in the portfolio. And there's been a lot of pessimism about investing in China, that the Chinese government is, that the Chinese economy is contracting, that there are political problems, and there's been a lot of negativity. How fast can that change? So you're talking about roughly September of this year, there had been a year of zero returns for the Chinese stock market. And actually, if you went back 2 years, you'd see the same thing. The global stock market has gone up 30, 40%. China has been totally flat. The Chinese government announced some very positive news. That's what the market consider it positive about stimulus and about economic recovery. And you can see that in the course of about 1 month, we went from zero return to positive 20% return. As a matter of fact, at this peak, it had been better than the global stock market. And this just goes to show you, like, something that looked really negative or was getting a lot of press can easily catch up very quickly in markets. Whether this is an overreaction, you might argue that, like, how can it be that positive when it's been that negative, right? This is how markets are very fickle, and news can drive positive news, it can drive negative news very quickly. But also, if you don't have some exposure, you can miss out on these big ups. The ups and downs are not linear. It's not a matter that something can be really flat and negative, and then all the growth can happen in the course of a month, and then there can be flat again, and then a growth. So that's one of the reasons we really want to stay invested in these asset classes that maybe aren't doing well right at the moment, but can have a big boost. And I thought this was just a super good example of how something can be sort of negative news and then quickly turn to be a positive news when you're talking about one slice of the market, one country, one asset class. So we're keeping an eye on China. We have exposure to that in our emerging market funds. It's a relatively small part of the portfolio. So this is not swinging your portfolio, your returns super positive or super negative either way, but I thought it was important to talk a little bit about how quickly that market has changed. So that's on to the election. If the Chinese government announcements can make such a difference in markets, why should you worry or not be worried about a very important election that is coming up in the US? So a few things. I thought a Mythbusters edition would be nice because this is one of the questions we get the most, and I think it's one of the most difficult things for investors to sort of stay the course through. If there's one thing, I think that we all have strong political beliefs, and politics matter a lot in terms of what's happening in the country in many ways. But it actually turns out that from a stock market standpoint, over the long run, they don't have much influence at all. So I have a couple of charts that I want to go through to talk about that. The first is that you had a question earlier about cash. Common thing, I will just sit on my cash until after the election. That will make me feel better. Who knows what's going to happen right after the election? During the election is a really bad time to be invested. So this is returns by quarters of the US large cap stock market. This is the first quarter, second quarter, third quarter, fourth quarter. The yellow, I see I flipped the colors, but the yellow is all years since 1926, which is the longest period in which we have good data. The yellow is the average return in those quarters, all years. The teal blue is the average return in that quarter for each of the presidential election years. Because it's not a super long time period, because it's every 4 years, I wouldn't put a whole lot of statistical significance in the fact that it's 1% here and 2% there. But what I would say is that what you see is that statistically, historically, the returns in the third quarter during presidential election years have been number one, positive, and number two, as good as or better than the returns in the third quarter in any year. So the third quarter, so that's right, September, October, November, the fall, and the fourth quarter as well, they've been positive, and they've been as good as or similar to the returns in all years. So there's nothing to suggest that an election year in the third and fourth quarter is a bad time to be in markets. And you might actually argue that it's a good time to be in markets. And why might that be? A couple things. One is, in the fall, markets are generally more volatile, right? That statistically in the fall, for whatever reason, there's a lot of arguments about seasonality, but in general, markets are more volatile. Generally, if conditions are more volatile, investors demand a higher rate of return because it's riskier. There's more uncertainty. And so in general, elections have a lot of uncertainty around them. It is not clear who is going to win this election. It is not clear what that's going to mean for different favorableness to businesses, immigration, all kinds of things. But what's clear is that there's a lot of uncertainty, and therefore markets are more volatile, and therefore actually there's equal opportunities for positive returns. That does not mean the market is going to go up. Again, these are averages, but it does mean that there's no predictive power that it's a bad time to stay invested in a presidential election year in the third and fourth quarters. Now, that being said, the data does not always make us feel better, right? Like, it is a reality that we're human beings. Many of us feel very emotionally invested in the outcome of this election, and that there are going to be some of us who are very disappointed, regardless of who it, is elected, right? There's people who feel very strongly on either side. And so just because the data says it's easy to stay the course does not suggest that you should stay the course and not be worried, does not mean that that is not a very normal human reaction. If you're feeling like that, and if you're feeling like it's going to be hard to stay the course, please reach out to us to talk to your advisor. There are things we can do. There are things we can help you potentially get more comfortable, find more peace of mind during this period. And having a plan, we always recommend staying the course, staying invested, right? That's best. But also, if you don't feel like you can do that, it's much better to have a plan surrounding what you're going to do to manage that uncertainty than it is to just go in and have a purely emotional response. So I'm telling you to stay the course. I think that's the right thing to do. And also recognize that we're human beings, we're emotional. This is a very big deal. And we're happy to help you try and find a strategy that will be both okay for your investment portfolio and bring you as much peace of mind as you can. We can try to find you in this time.
Kristi, I think some people are wondering if this is an unprecedented election, because in many ways it feels that way. And if the numbers could be different. And I would just share that that not only have I felt that way in the past, there have been elections that I think maybe my fears at the time now seem a little muted because things have worked out, but we didn't know that during the election when it was happening in the past. And I think the other thing to remember is just that while presidents definitely have an impact on the economy and how markets will perform, there are also many other factors like technological advances, actions of foreign leaders, what happens with interest rates, and all of these things can affect markets. But I think that your advice is well heeded. If you would like to discuss this in more detail, please reach out to me or your advisor, and we'd be happy to talk through your personal concerns and help you make a good decision.
Absolutely. And also, like, I want to second what Paresh said, which is like, we've been through this, right? 2016, 2020, both of those people felt like it was a very, very consequential election. In one case with the same candidate, and we had those very conversations before each of those elections, and in both cases, this advice held, right? Like, it was a positive thing to stay invested in the markets in those kind of situations. So I think in the moment, everything feels consequential, right? That doesn't mean it isn't, but it's that historical perspective is there's been a lot of what felt like at the time very consequential elections in US history, even in recent times. And it is true that at least to date that this has been the case, right? The stock market hasn't crashed as a result of an election or an election outcome. Volatility, yes. As Paresh said, there are many other things that can cause economic difficulties, but the actual election or its results in the immediate term have not in these cases. The other chart I'll show is just the cumulative portfolio return of the S&P 500. If you go back to there happens to be the last 80 years, happened to be a very nice period because Democrats have been in the White House exactly half the time, and Republicans have been in the White House exactly half the time. So we can do a direct comparison of two scenarios. One, you are a Republican and you only invest in the stock market during Republican administrations, and you hold cash the rest of the time. Alternately, you could do the opposite scenario, and you could be, I only support Democrats and I only want to invest in the market during Democratic presidential administrations, and I'm going to hold cash the other times because I'm so nervous about the other party being in power. Now, obviously, that's probably an extreme example, but the point of this is that, as you can see, investing only during Republican administrations, investing only during Democratic administrations, or just staying the course and investing regardless of which party is in the White House, you can dramatically see that investing throughout, regardless of the administration, has far and away been a better strategy. If you look across, we have other graphs, which again, if you're worried about this, we can share that on average, there's no statistically significant difference in stock market returns between Democratic administrations, between Republican administrations, president, Congress. The economy is actually surprisingly agnostic when it comes to political parties. It can do well under Republicans, under Democrats. It can do poorly under Republicans or Democrats. And the fact of the matter is, the business environment, what's happening in the world, are far more consequential than the immediate political deal on the market. I'm not saying that there's no way saying you shouldn't vote or that political views do not matter or do not influence the direction of the country. I do not mean to imply that at all, but when it comes to markets and investment returns, businesses and the economy are surprisingly good at adjusting to new economic times. It might take a little bit, but they adjust, and investment returns can be delivered regardless of what party is in government. And so every election, everything can feel consequential. This is what has happened in history, and there have been many different times, many different wars, many different protests, many different consequential economic decisions that have been made. I think we forget, as Paresh always says, we forget how those felt in the moment, how significant it felt in 2020, 2016, 1980. All of those felt like very consequential elections at the time. And yet the market was able to deliver positive returns regardless of who was in the administration. So hopefully that brings you some peace of mind regarding your portfolio, separating from your political views and your potential concerns. But again, as we said, if there is steps that you think would bring you peace of mind, let's reach out to your advisor. We can talk through some options to allow you to meet your financial goals and also potentially work through these emotional times in a way that that is both successful financially and also can help you stay the course. We have a few more minutes before we wrap up. Paresh, any last questions?
They're related to the election, and I think a lot of the information that we shared. And I think that in this forum, it's sometimes hard to answer all the specific questions. So I believe some of the folks that have more in-depth questions are scheduled to meet with their advisors. And I would welcome you all to reach out to me if you're not working with a specific advisor here at Merriman, and I'd be happy to speak with you in more detail. And if you let me know who your advisor is, I can have them reach out to you, because it is an unsettling time with the election that's coming up in 3 short weeks, and it always has been. And I think sometimes it's hard to listen to this advice in the present, but if we zoom out, we can see that the world has dealt with some terrible leaders and terrible times. And it's also important to understand that we are globally diversified. With rebalancing, we have a plan in place. If volatility occurs, we will make changes as markets move in different directions to rebalance, to take advantage of buying at low prices and selling at high prices when those changes occur. So I think we can make these slides available to those that.
Oh, absolutely.
Yeah, and there will be a recording that will be uploaded to the website. So.
Correct. And we have a piece coming out on the election that will be available in addition to these slides, which covers this as well as a little bit more specific information. And there's a wealth of other materials regarding, again, Congress, regarding specific returns in different periods. So if you have any specific questions, there's a lot of materials available, but we do have a specific piece on the election that will cover this as well. So as well as the recording. So thank you all for your time this morning. And again, feel free, if you're a client, to reach out to your advisor. If you want to learn more about Merriman, you can go to our website, merriman.com, and schedule a meeting. If you want to reach out specifically to Paresh, feel free to do so as well, and we will get you connected. But there's an easy button on our website, merriman.com, to book a meeting and to talk to one of our advisors if you have any concerns. Or again, if you're a current client, feel free to reach out to your specific advisor or call or schedule a meeting. We'd be happy to work through any questions you might have. And with that, thank you again for joining. And hopefully this was informative and brought you some peace of mind with regards to what's going on in the economy and your portfolio.